Good morning, everyone. It's 9 o'clock as ever. We'll be very generous to those that are just, finishing off their morning routines, getting their coffees, final bites of breakfast, or just arriving in the office if they've made the trek in. So we'll just give another minute or two just to let any last minute joiners enter, and then we'll crack on with today's session, which is a bit more deeper dive, more sort of worked examples on some of these implications of the changes in the Charity SORP, with specifically around the leases. Right, I think we're expecting a few more to come in, but let's do introductions, talk about fire exits, all those kind of things, and get started, and they can join from here because there's a lot to go through as ever. So welcome everybody. Thanks for coming. For those that have been before, Ruckmall, I see that you can't hear anything. Hopefully everybody else can. Ruckmall, it might be that you need to exit and rejoin. So just apologies for that. So welcome. My name is Dickon. I'm an audit partner here at HW Fisher. I am going to take us through this morning in a relatively whistle-stop tour, a bit more of a deep dive specifically around leases, the changes in the SORP and FRS 102 and what that might mean, things to think about ahead of year ends. If you are sort of March, June, July, you've got a while to go, but certainly things to think about now and the potential implications before that sort of happens. For those that have joined sort of before, we've run through it as a high level. Today we're looking to go through a few more worked examples. HW Fisher is part of the wider summer group. So I'm based out of the London office. We have a very large not-for-profit team here, but obviously we have hubs and offices across the country. So I know a number of you are joining from across the country. So just putting into perspective what that means. But obviously questions throughout, please do put them in the chat. Damien is there and picking them up and giving them to applicable people in hubs or to myself. We've got about 30 odd slides to get through in an hour. I won't ask anybody to do the maths, but it does mean we have to go through at a relatively quick pace. Some of those, obviously, we can canter through some of them. I think we'll need a little bit more time and discussion. I think the aim today, as I say, really get into it, get some worked examples of actually what are the implications, but maybe pick out some of those judgments, some of the areas where you need to sort of start thinking about, maybe talking to trustees, talking to your auditors, talking to your accountants, getting your teams to think about, and sort of really sort of putting in place processes, policies, all of those kind of things, and thinking about the impact early. That's the main dream. Obviously, we will send these slides around. We'll send the recording. They'll be on the summer hub. So absolutely, if you've had to dip out early or just want to re-listen to some bits, it'll be there as a recording, and you'll receive the slides after later this week. So what are we talking about? We're talking lease accounting. I think we've, hopefully all heard about it now. It's probably been talked about almost to death, but we will talk about it some more. But really here, this is the changes in FRS 102 and therefore the Charity SORP. we are talking mainly the distinction at the moment between operating leases, finance leases. Finance leases at the moment would be on balance sheet. We bring both the sort of the liability, the asset on balance sheet. Operating leases we've left in those notes at the back, and we recognise expenses in the year as as they're incurred. So that's where we're at the moment. Obviously, the big change, the one that everybody's sort of talking about and likely having a lot of impact across all sectors is this lease. So this is a sort of module 10B now in the SORP. It's a hefty read, given that it's over, for just lessees, it's over 100 paragraphs, and obviously with cross referral to FRS 102. What they have been helpful with is a number of good examples. They've tried to add clarity of areas and things to think about, and judgments. We're going to pick up, not obviously on every paragraph and every detail, but some of the key points. But I would say that I think the SORP has been very good, has been very helpful in trying to bring out what it might mean and how that might be thought about. So worth a read. But the key aspect now is there is no distinction between operating and finance leases. Those operating leases will come on balance sheet. That is that is the key bit, and the key change, and what that will have quite a big impact on the looks of everybody's accounts. There are, as ever in these things, exemptions available. What do they look at? Like short-term leases and leases which the underlying asset is of low value. Those are the exemptions that have been sort of brought in. And what do we mean by short-term leases? Leases, a lease term of 12 months or less, and contains no purchase options there. So short-term leases, and where we're sort of talking about this is at transition. If you had a 5-year lease and you're down to a year or less, that would be considered a short-term lease. Obviously, entering into a 1-year lease would be a short-term lease. Rolling leases, these are something that, again, as I say, the SORP has been helpful. FRS 102 is quite quiet on it, as is HEFE SORP. But the Charity SORP is a bit more helpful, a bit more prescriptive, in that they say it's a judgment. I think it's around the intention, and we'll talk about lease terms a little later in this. But yeah, if you've got a rolling lease, you've got to think about who has the right to cancel it. Is it you? Is it the lessor? Is it both? What are the intentions with that rolling lease? How long is that lease? What is the ability to terminate? So one to think about. I would suggest that a lot of these rolling leases and short-term leases would fall into and meet the category of short-term leases, but you do need to probably think about some of the things we'll pick up later, and just again document why you've made the judgment, whether it is a short-term lease or not. You need to document that down for audit purposes, for internal consideration by the trustees. It might be quite a key judgment. Again, all these things could have quite a big impact on the balance sheet and the look at the financial statements. Low value assets. This one, again, already kicking in with some quite big judgments. Low value assets based on the value of the asset, regardless of whether the payments are material to the lessee. And what it's getting at there is, you might be a very big organization, you might be a large charity. If you are a 10 million pound sort of turnover charity, a company car might be immaterial to the financial statements, and therefore it might be argued that's a low value asset. Now, the SORP FRS 102 is saying no, you can't put it into the sort of the concept of materiality to the organization. You have to look at it individually at the asset level. What would somebody else think maybe that the value of that asset is? Is it low value? Similar, this is all sort of stemming from an alignment to IFRS 16 and the international standards to make it more consistent across the board. When IFRS 16, was a similar sort of idea, but with out a huge amount of help and assistance on that. Whereas FRS 102 has come up with some worked examples. So thinking about things that would not be of low value, and again thinking about your organization's clearly likely railway rolling stock, aircraft and aero engines probably aren't going to be everybody's assets, but things like cars, vans, some of these things might might be something that the organization has. Certainly land, buildings, all of these just, even if it's a small amount, it's not considered low value because of what it is and the value to maybe somebody else. So it has been prescriptive. This is what the examples they've given. Not everything is obviously in there, but this is to slightly think about. And here is your judgment. So if you've got rolling leases, we've already thought about those in a sort of short-term lease concept. Low value items, you've got to go through your leases. You've got to think about why, if they do meet the criteria, that they are low value, what your consideration is, and the key part here is you can't make it in comparison to the size of the organizations. I always think, when I helped with the transitions of IFRS 16 sort of 8-9 years ago, at the time, I think IFRS, the sort of the standards, and when they came out, they sort of talked about $5,000 being international as a sort of idea. It was never a rule, but it was a sort of an idea that maybe something under that was low value. Now, FRS 102, the SORPs haven't come out with that. They've come out with examples of what wouldn't fit. But I always sort of like to think back, well, if IFRS had sort of also said that, maybe that's a slight concept, but it's not something you can, make as your line. IFRS said this, so therefore this. You've got to come up with a judgment. You've got to document why it is a low value asset. For low value assets, for short term leases, if you take the exemption, there are disclosures at the back, but you will just continue to recognize that as effectively an operating lease. So you will just, business as usual. There will be additional disclosures, but that is the treatment if you take the exemption there. So that's the exception to sort of module, or the exemptions to module sort of 10B, and where we're sort of thinking about what what you need. Definition of a lease, it's based, as I say, on IFRS 16. It's on balance sheet. A lease is a contract or part of a contract that conveys the right to use an asset for a period of time in exchange for consideration. So there is a little bit of nuance throughout all the standards. But from a charity SORP point of view, a lease is a contract or part of a contract that conveys the right to use an asset for a period of time in exchange for consideration. So I think that, that's the sort of key bit. It may be relatively, self-explanatory. I think, where they go into, and as I say, I think the SORP is really trying to be helpful to users here. They've sort of said it should be fairly clear in the contract, in the agreement. But if it's not, there is a judgment to be made, and these are the kind of indicators that would push you towards that there is a contract. Now, this is a lot more detailed than probably FRS 102 and HEFE SORP, but it's that contractual agreement is agreed by the parties. The contract may specifically identify the asset, or the asset may be implicit, which it is made available for use of the asset. So all of these things are thinking, have I got a contract, and does it allude to or push in this direction? I think the key part here in this sort of boldness is more consistent with everything, is that agreement gives the lessee the right to control the use of an identified asset. So what do we mean by that? That's direct the use of the identified asset and obtain substantially the economic benefits from that use. So the idea and the concept of this change, obviously IFRS 16 came in first, and aligning to that. But I think the point was, and It is not. We are not the standard makers as auditors. We are just, you know, there and then making sure that the financial reporting is aligned. But I think the concept was a lot of operating leases are done to obtain benefit from it. So actually, is it clearer to the readers of the accounts by saying, look, you know, we're gonna obtain all this benefit, and then you know, we might uh, also therefore have this liability, but we should be possibly acknowledging the asset that we have through this operating lease. So these are the identifying features. So this is a little bit more of the prescription of going, right, if it is not obvious immediately from the contract, will we, you know, do we have some sort of lease involved? So those are the things to think about. As I say, the real aspect there, and one of the key parts is around whether or not the agreement gives the lessee the right to control the use of that asset. Um, Whirring hopefully to the next slide. I think sorry, we've jumped a couple. Sorry, I'll go back. There was a little tech glitch there. So lease and non-lease components. And I saw a comment come up on screen about break clause. We'll get to lease terms in a little bit. So yeah, absolutely. So lease and non-lease components. One of the key differences between the SORP and FRS 102 and charities and probably corporations is there is a much higher chance of non-lease components within a wider lease. So it's this idea that a contract may contain multiple components, of which some relate to the lease of the asset, and some may relate to non-lease elements such as services, and should be recognized separately. And what are we talking about that? We're talking about peppercorn rent, we're talking about social donation leases. So, you know, there's a lot of again, definition in there, but peppercorn rent, we should potentially be familiar with anyone that's a residential leaseholder themselves, but also, you know, from what we get, the peppercorn rent is effectively where we are basically, we have a lease, but our payments are negligible, nearly nil, you know, so peppercorn. So that's the peppercorn run. The social donation leases is where we may be paying a subsidized amount, but still a significant amount. So, you know, so typically arrangements under which charity pays nil or only a nominal amount of consideration is known as peppercorn. So that's that bit where we're paying very little. The key here is for peppercorn, that's probably outside of this lease. It's not got that commercial value. Are you getting some sort of benefit? So module 6, donated goods services, I think it's then being moved to there, going, well, actually, yes, you have a lease is there, but it's not a lease as such. You're not paying. You take that away and then go, right, maybe if we're paying nil, we're actually getting goods and services, and thinking about it under module 6, not under module 10b. So peppercorn rent, look at it, you've got to identify it, but then you're thinking about it maybe somewhere else on that criteria. Social donation leases, similarly, there might be part. So it might be a bit of a mix and match. So you might have a lease, and I think this is where we're going to get into some worked examples. You might have a lease, and then some of it maybe thought about the non sort of lease component part might be thought about under module 6. So you've got to be thinking about what you've got in terms of agreements. You know, these leases you might have, certainly for properties, I see it quite often with a number of my clients, you know, where they potentially are paying less than market rent for the office space, or otherwise it's part of you know, the wider sort of corporate social responsibility that's given the charity cheaper rent. Now, we might have been just accounting for that as our operating lease historically. we now need to think about it. Are we actually, is the wider lease, would it have been more? What would we have paid, and therefore should we be recognizing some degree of revenue under module 6, and then also some degree of lease? So trying to bring this in again, the SORPS has a couple of worked examples in here, but sort of talking about it now, because I think there is a couple of key sort of considerations here. So what do we mean by this? The lessor states as part of its corporate social responsibility activities, it will give the institution a 50% discount on office space. So the institution, the charity, will pay £60,000 a year instead of £120,000. The key concept here is, if the arrangement had not been available, the institution, the charity, would have gone and expected to pay £72,000 for that rent of the office. They weren't going to go and pay £120,000. They were going to go and find somewhere for £72,000. So what does this mean? What does it mean in its treatment? So where the institution terms that it is a facility it has received under the arrangement, is the value of the institution, the office space, that is important. So that's £72,000. What we would have paid is the key part. So the non-exchange component, where we're thinking about under module 6, maybe as therefore as a sort of revenue coming in, is £12,000 per year, because we're paying 60. It's a 50% discount on £120,000 lease. We're in luxury offices. But actually, if we hadn't got that 50% discount, we were never going to be in those luxury offices. We were going to find somewhere suitable, and it would have cost us £72,000. So the concept, the non-exchange component that we don't treat as a lease, is the £12,000 that will get separated out and considered elsewhere under module 6. The rest we would treat as a lease. But so there's £12,000, the difference between the 60 and the 72, not the 60 and the 120. So that is quite important. It's quite important. Again, in this works example, it's all there. You might have a situation where you are in this situation, you are getting a discounted rent for office space. You might need to go and find, what would you have spent? Could you have spent less than the full price, or is the full price of where you're renting at the moment, that is the market rate? So you would have, that is the total amount of non-exchange components. So there is a bit of work to do there if this is your situation, because you've got to be able to demonstrate, absolutely, I could have, in this example, I could have gone and rented somewhere for £72,000. It's no good saying our limit was £72,000 if there was nowhere that you could have rented in a similar spot, if you needed to be central, or if you needed to be in a certain place. If you can't do that, then it's no good saying, well, we would never have spent this much money, because maybe that's your only option. So another bit of judgment there, but this is really sort of fundamental. It's really sort of different from corporates. Bringing this non-exchange transaction, how are you separating them out? What is the right price to bring in? How does that then look? So when you're then bringing down your net present value, which we get to in a bit, is those considerations are going right. What value am I using as my starting point? It's not the 72. It's this, it's the 60,000. But I've got to recognise that £12,000 somewhere else. So again, a lot of thoughts. I think I know a lot of clients and a lot of organisations I talk to do get free space in an office, that you're not necessarily using every day, but it's available to you all the time. Are you getting a lease there? What's the rights and aspects there? What's the value of that? What would you pay? Would you use it? So again, just got to document these down. You've got to think about them and make those judgments, run them past trustees, all of those kind of things. So lease terms, this was a sort of a question we sort of brought in within the sort of FRS 182 and those kind of bits. Is starts, the commencement date is the date at which the lessor makes an asset available for use by the charity, and includes any rent-free periods provided to the charity by the lessor. Now, I think this is again important to think about. probably comes around more in office space than maybe equipment or cars or other sort of common leased items, is that idea that you could enter into that situation that the lessor, you might sign the agreement, but the space isn't available. On signing, it's going to be available in 2 months, so it doesn't necessarily start at the signing date. But at the same time, if you've signed an agreement and it is available straight away, but you don't move into it, you don't pick up whatever the piece is, the commencement date still is when it's available. So it's not on use, it's not on are you using it, it is when it is available from the lessor to the lessee, and at that point that would be the start of the lease. Now the lease term then is, in its simplicity, is the non-cancelable period of the lease. So it's sort of flashed up on there, break clauses, absolutely, we'll talk about that now. So your straight out expectation is the non-cancelable period of the lease. Periods covered by an option to extend and effectively the other abilities to terminate is it's your reasonable certainty of either extending or terminating. So if you have a break clause, or if you have the equivalent way around, you've got a 5-year lease with the option to extend, is at the point of commencement, how certain are you? Are you reasonably certain you're going to extend it? Are you reasonably certain you've entered into a 10-year lease with a 5-year break clause? Are you reasonably certain that actually you're gonna break at the 5-year? You were never going to go for the 10-year. So it's either very straightforward, the non-cancelable period, but if there are aspects and areas where you could either extend, and this is where right at the start I talked about those rolling leases that that may be 12 months rolling, or even in certain situations 1 month rolling. I think the SORP has covered itself there by going, think about your intention. What are you going to do? Are you really going to, just because you can, are you going to cancel it after a year? Maybe this is something that is something that you're going to use for 5-10 years, and therefore maybe you should actually be saying that rolling lease is something we bring in, even though it's a rolling lease, because our intention is we're reasonably certain perhaps that we're going to use it. So that's the lease term, thinking about that. So some of the ideas in both SORP and FRS 102 is what are the indicators where this is a judgment. Immediately we're into another judgment. If you've got an option to extend or an option to break the lease, how do you define reasonably certain? What are you going to demonstrate to the trustees? What are you going to demonstrate to your external auditors? That yeah, absolutely. We're going to break this lease in 5 years' time. Well, what are your thoughts around that? Is can you is there a significant cost to extending or breaking? Would that prevent you from doing it because actually the cost of doing it is a lot, and it's not commercially sensible to do it? Have you put a lot into the lease? So for example, you take on a property, you've made significant leasehold improvements, you've really changed the office space to fit your organization. That would indicate that maybe you've got no real intention to break the clause, or you've got every intention to extend it if that's the way around. So how much work have you done to that lease? Is it a key lease? What is the importance of that underlying asset? So again, is it an office space in a really key location for the purposes of the organization? Is it a vehicle that you're going to have to get out to fulfill the charitable objectives? What is the underlying the importance of that underlying asset? If it is important, it's going to be harder to argue that yeah, we're probably gonna probably leave it. If, say, again, an obvious one would be a central city location was really important for the office space, and you've got a 10-year lease with a 5-year break clause. is it reasonably certain that you're going to take the 5-year break clause? Well, it's a really important space. It's maybe a good value. You've locked in that value now, and rent's going up, and it's the right location. Actually, it's going to be hard to argue that you're going to take that break clause. You're probably reasonably certain you're going to use all 10 years. Therefore, that lease term from the start date when it was available, you're taking it over the 10-year piece. We've got cancelable and renewable leases. So FRS 102 talks about the non-cancelable period, and it's determined by which the contract is enforceable. A lease is no longer enforceable when the lessee and the lessor each has the right to terminate the lease without permission from the other party, with no more than insignificant penalties. Where the lessee has the right to terminate a lease, that right is considered to be an option to terminate the lease available to the lessee when the lessee is determining that lease term. So going back to that break clause of the extension, if it is the lessee, if it is as lessee, we're looking at this as lessees here, if it is your right to terminate or to extend, then really we're likely to that's within our gift. Conversely, where it's the lessor has the right to terminate the lease, the non-cancelable period of the lease includes a period covered by the option to terminate the lease. That's ignored. So if you enter into a 10-year lease, the lessor has the right to break after 5 years. As the lessee, when we're calculating our lease term, we have to kind of ignore that. We don't have the option here. We basically have entered into a 10-year lease. Is the lessor's ability to break it, so we have to ignore that. So that's quite a key differential about cancelable periods. If it's both, we've got the option. Really the key here is how much influence can the lessee have. So what we're talking about here, some practical examples. These are sort of from sort of FRS 102, they're applicable to the SORP. So if SID Industries has entered into a contract to lease an office space from LHB Co Limited, the contract has an initial non-cancelable period of 2 years with an extension for an additional year if both parties agree. There is no significant penalties for either party if they do not agree to extend for that additional 3rd year. So the initial 2 years, absolutely non-cancelable period, meets the definition of a contract because it creates enforceable rights and obligations. Have to use that 2 years. The 1-year extension period does not meet the definition of a contract because both parties to the lease can individually elect to not extend the arrangement. Therefore, at the commencement of the lease, neither party has enforceable rights and obligations beyond that initial non-cancelable period. So from a very vanilla point of view, you've got the 2 years, absolutely. That 3rd year, it doesn't form part of that non-cancelable period. It then becomes a judgment, whether you include it or not, what is the likelihood, all of those kind of things. But the very first part, because both parties have the right to, not extend if they don't want to, it doesn't form part of that non-cancelable sort of part of the contract. It becomes a judgment. Whereas in this example, Lyra Limited, the lessee enters into a contract to lease a warehouse from Twizzler Properties for 15 years. The lessor has the option to terminate the lease after 6 years. The fact that the lessor can terminate the lease after 6 years is ignored. So that bit doesn't matter to us, because we have to consider the length of the lease at the beginning. We can't cancel it. We can't make assumptions what the lessor is going to do. So we have entered into a contract as a lessee to take on that property or whatever it may be for that warehouse for the entire period. So that's talking about non-cancelable. From there, like the previous example, you need to think about the judgments around whether or not you're going to extend at that point. It's at the beginning point. You do revisit it as you go if you've decided one way at the beginning and then it change your mind a year later. But at that initial part and initial entry into that lease, you've got to think about firstly the non-cancelable. What is the non-cancelable period? Then is there a judgment? Is it up to us as lessee to be able to extend or to reduce? And how likely are we reasonably certain? There is no threshold, there's no 80% sure or anything, reasonably certain, but there are some clues and indicators of, actually arguing we've done a lot to the assets. It's really important to us. We're probably therefore reasonably certain we will continue with that asset. So we're going to extend out beyond that period. But that's the judgment there. But start with what is the non-cancelable period? That's your minimum. Then there are some judgments and decisions there. And absolutely pretty key judgments and decisions. Having a 10-year lease versus a 5-year lease, especially on a property, that is potentially a much bigger number that's being brought onto balance sheet. So need to think about that. Need to really re-review those leases in a way that makes sure that you've considered some of these and gone into the detail of it. Once you've considered the lease term, you've got a lease. We know what that is. We've considered the term of the lease, the start of the lease, on commencement of that lease, when the lessor has made it available to us. How do we then account for it? Again, SORP is really helpful here. It's a lot of detail. As I say, just from lessee accounting, it's around 100, just under 110 paragraphs that it goes into in module 10 and cross-referring to FRS 102. So there's a lot in there. In the basic sort of format of it. On the commencement of a lease, a lessee shall recognise a lease liability at the present value of the lease payment still to be paid, and a corresponding right of use asset. So in its most vanilla format, we enter into a lease contract. We will bring on a liability to sit in our balance sheet, and a right of use asset. And in its most vanilla form, they will net off. Your balance sheet will inflate hugely, but the net impact at that initial stage will be zero. And therefore the classic question of, what's the point? But that is not why we're here today. We're here to make sure we account for it correctly. So very straightforward, easy, we get it in. Unfortunately, again, as ever, more judgments, more thoughts, more considerations to be agreed. So a lease liability, how is that measured? What are we talking about with regards to future payments? So we've got to work out that lease term. That's our first judgment. So we then know how much we're going to pay, because we know our lease term, we know our commencement date. So therefore, we need to bring those back. So it should be measured at the present value of those lease payments. So what are we paying? Don't forget, within our we might have some peppercorn or sorry, social donation lease. So we've got that sort of lower value. So we maybe got some revenue there, but yeah, what are we going to be paying for our lease over the lease term, and then discount that down to bring it back to its net present value. But there are some other variables. There are other sort of pieces. The basic, that is your fixed payments. That's your lease agreement. These are the terms of your lease. What about other aspects to it? Variable payments. It could be some variable payments, that are included, some increases for certain reasons at certain periods. If those variable payments are dependent on a fixed index, so CPI, RPI, something like that, and every year the rent will go up by CPI or RPI, then you include an estimate on those. So yeah, absolutely, you should be going, look, there is almost a guaranteed increase. We know what it's going to be. We can calculate it. We'll bring that assumption in. If it's not measured, so in certain, if they've got a sort of a trading arm in the charity of the organization, that if you've got sort of trading arm that you might have based on turnover or revenue or something like that, the lease payments might change. You can't include those because you just don't know. You can't calculate that. So it's one of those things that if it's measurable, ideally against an index or something like that, then absolutely. But if it's not, you ignore it, you make those variable payments each year as a cost going through, but otherwise you bring it in. Other things like amounts expected to pay under residual value guarantees or purchase options or any sort of penalties, they also need to be included here and added on to before it's discounted down. I see that less, but obviously we've got to think about it. As with these things, the chat is flashed up on me. It's not a huge amount, but we talked about dilapidations. We will get um, uh, to a point here where we've got dilapidations. We've got the right of use asset, so bringing that sort of in. So just finishing there, we've got the lease liabilities, that net present value. So we've discounted it down, we've brought it back, we've considered certain variable payments, but it's mainly those fixed payments coming in. The right of use asset in its basic form is the opposite to the liability brought on, and that would be the most vanilla. However, we've got to think about now some of those obligations for cost to dismantle and restore. So dilapidations, when we've entered into that lease, are we thinking that we are going to have to make dilapidations and payments there? So if we are going to have that initial provision, that actually is brought in as a separate liability and added to the right of use asset, and then depreciated down. So you're taking that cost over the life of the lease effectively. So that is quite a big change. I know a lot of clients don't like to think about dilapidations until maybe that sort of last year or two, because that's sort of argued as immaterial. Now we have to think about them up front because we should be adding them to the right of use asset, and then they're being written off as part of that wind down of the right of use asset. So that's where your dilapidations sort of come in. Any initial direct costs as well, they'll be added, almost sort of capitalized into your right of use asset. And again, therefore the idea being is they are wound down, they're depreciated over that length of the lease. So in its vanilla form, as I keep saying, the right of use asset and in the first year or on recognition, the right of use asset and the liability match. But there are a number of reasons why that might not be the case for a right of use asset. If there are costs incurred, incentives, dilapidations, you're going to bring those into the right of use assets, increase that. So you might have a bigger asset initially than the liability because of these other pieces. So a lot to think about again there. As I say, most common in these scenarios are obviously the dilapidations, which are often left, as I say. So you got to start thinking about that at the start. What might it be? What might the cost be? How does that work? Let's bring that in. Discount rates. So it's all well and good bringing things back to their net present value, but what rate should we be using? What are we thinking about in this scenario? So the default is if the charity can readily determine the interest rate implicit in the lease, then this must be used. It might be that you can ask the lessor potentially. I think the SORP sort of pushes you, could you ask them, is it written in the contract, in the lease itself? Is there a value in the lease itself that you can use? Is it implicit in that lease? If it is not implicit, then you can choose on a lease by lease basis to apply incremental or obtainable borrowing rates. So if you can, if it is implicit in the lease, if it's in the agreement, if it's, you can point to a discount rate, that must be used. If you can't, again, learning from IFRS 16, it became quite complicated. The SORP, the FRS 102, have really trying to make it a little bit simpler by allowing to have incremental or obtainable borrowing rates. What do we mean by that? I think this is it's nuanced. I think The incremental, I'll read it and then we'll maybe just to sort of just talk through it. So the incremental, that rate of interest a lessee would have to pay to borrow over a similar term and with a similar security, the funds necessary to obtain an asset of a similar value to the right of use asset in a similar economic environment. So that's the incremental, the obtainable borrowing rate, the rate of interest a lessee would have to pay to borrow over a similar term and amount similar to the total undiscounted value of the lease payments to be included in the measurement of the lease liability. What does that mean? I think the key part here is incremental is what we're saying is, could we borrow an amount using, if we had the asset that we're taking on, using that as security, and then having, and then borrowing that amount with that security to obtain an asset of a similar value. So if you already had that asset, could you go to market? And that's probably quite important, because if you've got more security, you're likely to get a lower interest rate on that loan. It's going to be harder, undoubtedly, to evidence. It's a bigger judgment. It's not obviously impossible. It's, why it's there as an option. The obtainable borrowing rate is a bit more straightforward. If you took the gross payment, so you had 10 years of £100,000 a year, if you needed to borrow £1 million just outright right now, what could you go to market and get? What could you go to a high street lender and get £1 million as a loan in your current organizational situation? If you needed to go and find £1 million, how much would you have to pay in terms of interest for that loan? So the obtainable is based on that gross. It's based on just the situation. You need to go to market. You need to find that. The incremental, slightly more complex. It's around, actually, if you had the asset of a sort of similar value now, and you had the asset as security, what could you go and borrow on that basis to get another asset of that similar amount? So, as I say, it's a bit nuanced. I think, there is a lot of judgment around that incremental. Again, if you've got good relationships with bankers, financiers, whatever you may have, they might be able to help you with that. The obtainable one is slightly more straightforward. Again, you might need to speak to your bank, because you might need to go and evidence, actually, we could go and get a loan. These are, if you had to go and get a loan, what would it be to get that discount rate? And and it's quite important. Again, that discount rate is going to have a huge impact on your initial balance sheet, but as we'll see, the unwinding of the asset and things like that. So discount rate important. First and foremost, if it's in the lease, implicit in the lease, you have to use that one. If it's not, there's a judgment and you do it by lease sort of basis, the incremental borrowing rate or the obtainable borrowing rate, and you get to sort of choose around those. But it is something you're going to have to think about, evidence why you can't potentially sort of simply say, I know loans are there. You might already have financing, so that might give you the clue. You could go, we've already got a loan out, we've got some financing, we've already borrowed a similar amount, and it's at this rate. But it might be that you actually do have to sort of either go to your bank, talk about it, get some evidence in there. But it's going to be a judgment, and again, it's a bigger judgment. The more leases, the bigger the leases that you have. Just going to spend on it. Again, I appreciate some of our comments in the chat, but just trying to get through some of these worked examples so that everybody's got a viewpoint, and then we'll pick up on pieces if we have at the end. But otherwise, we'll drop an email or and answer those for considerations. But just kind of wanting to bring that together. What are the implications here? So spend this sort of last 10 minutes going, here's a worked example. What do we really need to think about now? So I've got Colonel Trust to sign a 10-year lease on the 31st of March 2025 to lease offices. There's a break clause attached to the lease whereby Colonel can exit the lease after 5 years. The lease rentals, they're £180,000 per year, paid on a monthly basis. The lease previously met the operating lease criteria of FRS 102 and the SORPs. So we've got an accounting reference date of 31st of July. There's no upfront fees. We're keeping this quite vanilla. There were no upfront fees were payable on inception. There's no lease incentives, and we don't think there's any dilapidations at this point. Charities gone out and obtained that they could borrow the money from a reputable high street lender at a rate of 8% per annum. And then the lease payments are profiled in as follows. So you basically have £180,000 a year, or effectively £15,000 a month. We've ignored any VAT, taxes, anything else that would sort of complicate this. So it's very vanilla. What we're saying, we've entered into that lease at 31st of March 2025. We've got £180,000 a year. We have the potential for a break clause, and we've gone to the lender to think about that 8%. Just on that 8%, and going back to your lender and your implicit and explicit and your obtainable interest rates. Again, one of the key judgments going to that is going to be being comfortable and confident about what your lease term is. Obviously, the longer the lease term, the bigger potential asset that you're borrowing, and therefore will have a potential impact on that interest rate. In this example, we know it's 8%. So on the principle that Colonel is actually going to take the break clause, so it's a 5-year lease, mainly to keep it relatively short for this worked example. This is what effectively the profile looks like. So in that initial old SORP, as we now refer it, we've got £45,000 to 31st of July 25 and £180,000 to July 2026. So those are treated as ever operating leases, expenses going through. What we've put down here is just what is not paid at the end of each, what have we got left at the end of each sort of period. So, if at inception we had 900,000 based on the 5-year sort of piece. So end of July 25, we've got 855, 675. So that's what we've got left outstanding. So what does that mean to us? We've got the transition in. So at that point, at the point of transition, the committed lease rentals, what we've got left is £675,000 to pay. We've got to bring that back down at 8%. That's what we can go to market. We can borrow. We've got that evidence from liaising with a high street lender. So we are discounting down. So each year, so the sort of the calculation is that 180 by 1 over 1.08, and then sort of multiply it up. So our present value of the £675,000 that is remaining in that lease is £563,000, 107. So that's the difference. Gross, we've got 675. Net present value, we have got £563,000. So we've not taken any retrospective. It's it's pretty clean what we're doing. We've made it very vanilla. We're recognizing the right of use asset at the liability. So our first journal is we're going to debit right of use asset £563,000, and we're going to credit that lease liability £563,000. So again, because it's vanilla, because we've said there are no dilapidations, there's no lease incentives, there were no costs to bring it into play, it is just a matching 563 and 563. So we've inflated our balance sheet effectively by the same amount, no net impact. How you present it, you can present it separately as a right of use asset, a separate line, or you can present it within your PPE in the notes. So absolutely, choice is yours. But we bring in the lease liability and then the right of use asset next to it. What does that mean then? We're going to then depreciate that right of use asset over the time. So we're going to create a depreciation. it's an asset on there. So at each reporting date, we've also then got to consider it for impairment. So a little bit of extra work for everybody. You're welcome. But yes, we will add that right of use asset in. We'll depreciate it over that period, and then we'll, at the end of each period, assess whether that asset is impaired. Effectively, what we're bringing there is a consideration of onerous lease, but you've now got that asset, so you now need to think about whether that's impaired and brought down. But it would be the equivalent of effectively considering onerous leases. So we've considered the time. We're going to bring that and depreciate the right of use asset. So that's that 563 over that period of 4 years. So we're going to depreciate at £140,000 straight line, reducing our right of use assets and hitting our P&L as depreciation. That is why bringing in things like dilapidations and all those things is considered the bringing into the right of use asset, because you're then spreading that cost over the period of the lease. Obviously, you will then continue, as one would, paying the cash over to for the lease. So you're paying your lease off. So that would be reducing your lease liability, and reducing your cash. So debit lease liability, credit cash. I think the key difference here, and this is really important, especially for those with potentially loans or covenants or other sort of aspects, but also just the shape and makeup of the accounts. We've depreciated the 140, that's what we've said. We're paying the cash of 180. But on top of that, we've got an interest expense. We've got a finance cost. We have to now unwind that lease liability. So we started with the 563, but we know actually we had £650,000 worth of payments due. So we're unwinding that lease liability. So this is kind of a look at where we've got to. So each year, you're then debiting your finance expense and you're crediting your lease liability. You're unwinding that 8% discount that we've done over the period. So you can see here we've got two different expenses now. This is different to the operating leases that we're used to. We've got two different expenses in two different places of the accounts. Now we've got an interest expense, which is the unwinding. So that's a finance expense for those with cash flows, and otherwise that will come in there. Depreciation expense, that's straight line. And then we see the impact on the balance sheet, the right of use asset, initially matching. After year one, we've actually got a bigger liability than we do asset. So we're suddenly created, just by bringing onto the balance sheet and a year in, we've actually created a net liability situation. It lessens over year two, it flips in year three, and obviously we paid it off in year four. But that is really, really, really important, because it's going to be shown in different places. You've got your depreciation, your write down of your right of use asset. You're going to have a finance cost now. That is going to debit finance cost, credit lease liability. You're increasing your liability by that finance cost as you unwind it, but you're also reducing it by the payments you're making on an annual basis. I think, as I say, hugely important for those that are in finance or covenants, but also just how it looks, how you write about your accounts, because it will now look different. You'll suddenly have a finance expense and potentially don't have any loans, and it might look seem strange. So how are you going to explain it and otherwise? So I think this is a really important sort of worked example. As I say, kept it very vanilla to try and sort of get that sort of piece through, but those key sort of journals and how it will look over that period and the impact it has on your balance sheet, from initially just inflating it, no difference, to then getting net liabilities and then potentially a net asset before obviously being paid off. I think there's a number of disclosures. There's a huge amount, but you've got to got to present right of use assets, lease liability separately. There is a sort of, in the extended disclosures, we talk about what are the leasing arrangements, what type of leases. If you are taking exemptions, what is the impact? What is the value that is being put through the accounts in those? So that will still need to be disclosed. Cash outflows, any expedients taken. If you've classed a load of assets together, you're going to have to explain which ones, and a reconciliation of right of use assets. And that's just just a few. There are a lot of disclosures. So your financial statements, do need, even if you've got one lease, there will probably be a lot more disclosure in there. So there's a lot of work to do around that. Just conscious of time. The other practical challenges, how you're updating your system. If you've got an automated depreciation now, or your operating leases are being automated and written off at the moment, how are you then going to bring that in? How are you going to separate out that recalculation of unwinding the lease into a finance expense as well as the depreciation? So do you need a systems review? How are you going to make that so you don't have to do it manually every month? So how are you going to be able to automate it? Clearly, the assessment of leases, what have you got in the way of capacity time? You've got to start now. There are a huge amount of judgments. You've got to document those, maybe take those to the trustees before they've gone anywhere else to make sure everybody's happy and clear with your judgments. There are a number of them. Loan covenants, impact on that. What do you need? Do you need to speak to your high street lender? All of those kind of things. So absolutely lots to think about. So don't leave it. If you're a March year end, don't leave it to next year. Don't leave it. Start thinking about it now, because it could be having an impact now, and you really need to start sort of working on it. Obviously, if you need more support, I know there was questions and chat in the chat. We'll pick those up. Unfortunately, it is 10 o'clock. So I'm going to have to call it there. 10:01 in fact now, so apologies, we've gone a minute over. Any questions, please do reach out to either myself, Damien, and the organisers of today, your local hubs. If you need support in considering these, calculating other judgments, and you don't have capacity, do think about getting support there. But it is something that's really, really important. It is going to have a huge impact, and something you have to consider anyway, even if you don't think there's any impact, because you're going to have to demonstrate that there is none. Thank you all very much for joining. Slides, recordings will be online, slides to be sent to you as well. Questions in the chat I will try and get to, but we'll be running more of these as we get closer and closer to the year end.